Hello, everyone, and welcome back. Today, we are talking about a topic that both Kevin and I have been writing and speaking quite a bit about lately: private credit.
It's one of the fastest growing areas in the financial market, Sarah, and it's also beginning to attract a lot of scrutiny and, not surprisingly, litigation as well.
Exactly. And also, from a DNO perspective, private credit is interesting because it sits at the intersection of lending, asset management, and structured finance, which are all places that we've seen claims activity historically.
Let's start with the basics, Sarah. What exactly is private credit?
At a high level, Kevin, it is private lending, meaning non financial, non bank lending. And it could be capital that's provided anyone from private funds like private equity, asset managers, or institutional investors rather than the traditional banks.
So, a borrower that wants to borrow some funds, instead of going to a bank, goes to one of these institutions that provides this type of credit.
That's exactly right. And it's a direct lending type of agreement, meaning they could go to this private lender and have a loan giving either as a bridge loan, as mezzanine financing, or even distressed debt in certain situations. And it provides more flexible and a broad strategy for private credit.
I know from reading in the financial pages that this has actually become a pretty significantly sized market.
It's massive. As we've discussed in our DNO diary posts, I believe this year they're talking about it being a $3 trillion asset class. And it's expanded in part because of more regulatory constraints put on traditional lenders like banks and investor demand for yield, which historically has been pretty strong in the private credit space.
As I understand it, one of the complications with private credit is that we're talking about fairly complex transactions. I mean, how are these transactions structured and how does it add complexity to the lending transaction?
Well, I think, what we keep hearing about is this lack of transparency, the opacity. So that has been a large risk that keeps getting highlighted in a lot of these stories that are coming out about kind of the risk associated with private credit.
I know that as some of the problems with private credit have started to emerge, certain types of risk have become apparent. And it'd probably be helpful to go through some of the types of risk that are emerging as these problems come to light in recent
Sure.
days.
Yeah. I mean, the valuation risk, right? So, as we have talked about this lack of transparency, how were companies that were receiving the private credit or coming into agreements with these private credit lenders, how were those companies being valued? If they were already distressed, will the company be able to repay the loan or the debt that needs to be serviced? A lot of that kind of indicator about how healthy a company's balance sheet was not made public initially. It was really internal to the private credit firms. So it was not marked to market, which happens with publicly traded securities, where there's a feedback loop that is coming from outside parties that are really studying deals and then stress testing them. Instead, it was a less open determination as to what these companies that would receive the private credit would be valued at.
Isn't valuation also about the underlying assets as well? Isn't that one of the valuation issues? Isn't it those the questions that are being asked as well?
That's right. And the way the valuations are applied is questionable. Like, what are the particular types of determinations that are being made, the types of algorithms that are being considered by these particular companies? So, net asset value, net NAV, has been brought up quite a bit. So, really, it's how these companies, meaning the asset managers, are viewing the valuations. They're not as transparent and they're also maybe not disclosed to investors.
Well, I know from many years of experience in this area, anytime you have questions surrounding valuation, you're going to wind up with litigation. But I understand that there are other concerns beyond valuation issues.
Yeah. On top of valuation, there's also layered capital structure. So, meaning that some of these loans, depending on how they have been created, if they're mezzanine financing, if they're a direct loan, those layers can be put in priorities either ahead of each other or potentially ahead of other vendors that a receiver of private credit may already owe funds to. So, having kind of this complex amount of layered debt can also be problematic.
It seems to me that anytime a borrower runs into trouble, these layers and structures are going to create conflicts among the stakeholders.
That's exactly right. And also between each other, right? So even with the stakeholders, as well as determining who the priority of payments needs to go to, can cause infighting and external disputes as well.
As I understand it, isn't another issue that's arisen involving questions of liquidity?
Yes, it's liquidity mismatch. It's really determining whether periodic liquidity that's being offered to investors are able to be paid out. So oftentimes, this private credit is debt. It's not available in cash right away or cash to pay back. And when there's concerns about whether or not these companies that have taken on this private credit are even are even able to have cash to pay back on these particular loans, that can be a problem when it comes to redemptions that investors anticipated would be paid to them.
So if I could summarize what I see as a common thread among the various concerns you've identified, there are things that may either cause problems for investors or may not have been disclosed to investors, and so it seems to me that we also have a disclosure risk as well.
That's right. And we've seen that traditionally, especially with D&O claims, that lack of disclosure can often lead to those disputes. So, ahead of time, if you're telling your investors, this is how we have structured the debt, these are the agreements we put in place, and this is what we anticipate to be the redemptions, that may be a better type of strategy than not being as transparent about valuation or payment structure or anticipated payouts.
Well, when questions arise regarding disclosures, it's usually after problems have arisen, and we know that when there are disclosure issues, there's often litigation. In fact, there has been litigation in this space. And the litigation that's been filed so far, as at the highest level of generalization, can be divided into two categories. There's litigation involving the borrowers, and two of the highest profile examples there are two major flameouts last fall involving two private companies, Tricolor and First Brands, both private companies, both significant borrowers in the private credit space and both bankrupt. And there have been huge claims activity involving those two failures. But there's also been claims on the other side, on the lender side, and those tend to be the asset firms that have a business development corporation arm that's creating these loans. And the business development corporation is publicly traded, and investors sue the, the business development corporation, alleging misrepresentations, the failure of disclosure. And there's already been a significant amount of activity in this space, and there's been enough activity. I think we can make some generalizations about what the kind of allegations are that lead to these types of claims.
That's right. And with respect to those asset managers, they can kind of be, meaning the claims themselves and the securities risk that have come up, can be identified as involving asset valuation disclosure. As we talked about, kind of the risks that have percolated with respect to private credit, the allegations against FSKKR and BlackRock TCP Capital Corp, those are again ones where you've seen asset managers allegedly not disclosing risks associated with the private credit portfolios they have. Those types of allegations also showed up in the suit against Blue Owl. That lawsuit, though, also had claims of conflict of interest. So, those business development companies that you identified, Kevin, the conflicts arise when the asset manager has the BDC as well as the valuation coming into play together, where again, we talked about that lack of not mark to market, where there's not a public vetting of the investment. And so it's easy for allegations to arise that kind of this internal valuation and then deployment of capital on behalf of investors was really conflicted. It was not for the benefit of the investors in the strategy.
And you mentioned Blue Owl. There have actually been multiple lawsuits filed against Blue Owl. And among other things, one of the suits alleges that Blue Owl made misrepresentations with respect to the redemption rights of investors. And there have also been claims filed against other firms, Hercules Capital. The allegation is the company had not been forthcoming with respect to its disclosures concerning its due diligence process, allegedly leading to poor credit quality than investors have been led to believe. The bottom line is there are just a lot of different factors contributing to litigation activity, and I think it's likely that that type of activity is going to continue for the foreseeable future.
I think that's right. And I think that kind of comes to, for us, it comes to mind, how do you underwrite this risk, right? What, from a D&O underwriting perspective, are you supposed to be evaluating, because private credit is in so many spaces and it is become an asset strategy that has been increasingly popular. So, one of the challenges that's a core challenge is the opacity and subjectivity. So, again, that lack of transparency, requiring more direct questions regarding how many assets are really illiquid. How is this asset strategy being valued, right? Is the valuation being disclosed? As we've talked about, those disclosure risks and valuation risks have already led to litigation against some of these asset managers.
Couple of things I would stress if I were talking to underwriters too is a point I've made before, which is private companies have been involved in these, on the borrower side have been involved. So this isn't a risk category that's exclusively limited just to public companies. There's private company risk here as well. The other thing I would emphasize is I think there's kind of a slow burn aspect to this. Many of the BDCs, the business development companies, which are the lending arms of the asset management firms, they're facing redemption requests rather, and the redemption requests are subject to limitations each quarter, which I think creates sort of a narrow funnel as people are trying to draw their money out. The limitations on the amount of money that can be withdrawn probably creates a feedback loop that creates problems. But borrowers, rather investors, are going to continue to try and redeem in future quarters. And each quarter, there's going to be probably redemptions up to the limit. So there's going to be a very slow ebbing of the aggregate asset valuation of the firms, which is going to create valuation problems for the shares of the business development companies, the kind of things that lead to more claims. And I think those things are going to continue to accumulate over the coming months and quarters. So I think we can probably expect to continue to see these types of claims as the year progresses.
Certainly. And those are all reasons why the risk of contagion is also an area of concern, is that other parties, not just traditional private funds that decided to become private credit issuers, have gotten involved in this space. And that includes banks, life insurers, institutional investors. And so with so many different, hands that kind of decided to deploy this particular asset strategy, there's also this concern that not just these private credit funds that focused solely on this strategy might have issues, but really other financial institutions and other lenders that may not have traditionally played in this space but got involved because of that initial high yield.
It sounds to me like we're really just in the early stages of this story. I suspect strongly that you and I are going to continue to be writing posts about private credit for the foreseeable future. But at least it's an interesting story. I enjoyed the chance to speak with you about it today, Sarah.
Yeah, you too, Kevin. And until next time, thank you for joining us.